Hi, this is Mark Item with HONU Trading with the weekly review for the week of August 14th, 2023. Education only, not recommendations to buy or sell. Know your time frame and risk tolerance. We're going to look at both the long-term weekly time frame, and we'll spend a little bit more time on the shorter-term swing trading time frame as well. If there is a holy grail in trading, it's the ability to manage and control risk. So never forget that is our job one. Follow me on Twitter at HONU Management, at HONU MGMT. So today's agenda, it was a week of mixed markets, clearly mixed markets. It was our fourth pullback week out of 11 since breaking above that S&P 420 level, SPY 420 level. And it's the first time we've actually had 2 consecutive weeks of pullback. The heat map definitely had a Christmas look, both red and green. Santa Claus would be proud. Biggies had their hits, but they still outperformed the smalls this week. I'm going to spend a little more time talking about the swing trading time frame. We'll look at 15-minute charts where trends last a few days to a few weeks. We'll also take a look at 2 different growth stocks that reported earnings this week. Celsius got jacked and SMCI got whacked, even though on the surface the headlines both look like beats. Reminder, it's not the headline that matters, it's the market's reaction. And we'll compare and contrast to see if we might have had some clues going into that. Risk on remains in effect, and we're going to do a sector review this week. I'm not going to talk about the financials anymore unless the stuff really hits the fan. Light earnings and data next week. There are a few retailers, they start to report. So let's dive in. The heat map, again, definitely a Christmas theme, red and green all over the place. The big caps, Apple down 2, Microsoft down 2, Amazon down 0.8%. Google was positive, up 1.27. Meta was down, Tesla was down, and Nvidia was the big loser this week. Some strength in the energy sector, both big and small cap. Some retailers, some of the and staples. Some of the big caps had nice numbers. Small caps, sensing a theme here, didn't do as well. Same thing in the financials. A couple of big caps didn't do that great. Kind of a mixed bag all over the board. So in a relative strength of equal weighted relative to capitalization weighted, the S&Ps really not much of a change. Same with the Qs. Mid caps gave up a little ground, but the small caps gave up a little more. Still in an uptrend. They haven't broken that high yet, but they have given up some ground this week. Let's look at the weekly time frame. And it's the second week in a row we've had a pullback in the last 11. This felt worse than it really was, at least in the SPY. It was only down 0.25%. Well above that 10-week moving average, which corresponds to the 50-day on a daily time frame. 10 above the 30, which corresponds to the 150-day time frame, and still above, and all of these are rising, the anchored volume weighted average price from the all-time highs. Qs, same story, although they did break the 10-week or 50-day moving average. Not big concern yet, but that does raise an eyebrow. Mid caps, they had a pullback this week. They were down 0.75%. The Qs, I forgot to mention that, they were down 1.5 percentage points. So all the moving averages are stacked in the correct order on the mid caps. Didn't come close to the 10-week or 50-day yet. Small cappers, same thing. They pulled back more. They had the worst week, down 1.64, a little worse than the Qs. But still all the moving averages in the correct order. This one has not hit a 52-week high as yet. So now let's turn our earnings to Celsius. Now Celsius was jacked on earnings this week, but it hadn't had much of a move compared to, as we'll see in a moment, SMCI. Now up 40%, 43% in a little over 3 months. That's not chopped liver. But compared to SMCI, which had been in a power uptrend for quite some time, and in that same roughly 3-month period had been up nearly 200%. Now, it would take perfection on earnings to avoid a sell-off here. So Celsius, again, great earnings, beat expectations, but it hadn't had the big power move. Been moving nicely, but not the big power move that SMCI had. Now, SMCI just been a beast, a part of the AI theme. So not surprising after that kind of a move. Buy the rumor, sell the news. So to switch to the swing trading time frame, I want to spend a little more time on this week. Again, a 5-day moving average on a 15-minute chart is actually 130 periods. That's 5 days times 6.5 hours in a trading day times 4 15-minute bars per hour. That equals 130. So one of the things that Brian Shannon advocates as his key primary rule, don't buy below a declining 5-day moving average. Well, look what we've got here. But I have highlighted, this is now 5 days ago. So starting Monday, these will start to fall off, being replaced with lower prices. Now, that's still above where we're trading right now. Yet, if we can just go sideways for part of the week, heaven forbid actually move a little bit higher, this moving average would not only flatten out, but start to rally a little bit. Now, if we continue falling from here, of course, all bets are off. But that's how the 5-day moving average works. By the way, ladies and gentlemen, this isn't prediction. This is just math. These are falling off. These are getting added. Moving average is going to continue to decline, but not as fast as it had earlier in the week. The risk on, risk off measure, hat tip to Chris at Chiovaco Capital. As always, this is the S&P 1500. That's your 600 small, your 400 mid, and your 500 large as one composite capitalization weighted index divided by or relative to the performance of IEI, the 3 to 7 year Treasury bond. Now, stocks will almost always outperform bonds, but this gives us a risk on, risk off measure in the intermediate term, since we're looking at daily. As this indicator is rising, stocks are outperforming bonds, risk is preferred. In the COVID crash and in the 2022 bear market in stocks, that's pretty clearly risk off. As you can see, there are 2 long periods of time with really no trend. But once it breaks out like it did back in mid-April, early May, then that's risk on again. Now we've given up some this week, but not that much. So now I'm going to pause for a minute and do a sector review. Okay, here we are with a sector review. We're looking at, first of all, consumer discretionary. We're looking at the daily time frame, so these are intermediate term trends. The green moving average boxes, when they're rising, the 10 is above the 20. When they're falling, the 10 is below the 20. When this is blue, the 50 is above the 200. And when it's gray, the 50 is below the 200. So right now, consumer discretionary, we broke above but failed to hold a 52-week high. We've pulled back some, but all the moving averages are stacked in the correct order. 10 above the 20, above the 50, above the 200. Energy has been starting to move higher, but still trapped within this big range from last year. Not near a 52-week high yet all of the moving averages are stacked correctly, and price is above all of the moving averages. Financials, we've talked about a lot. I'm not going to talk about that much more unless something goes haywire. Still trapped within this big pre-Silicon Bank, pro-Silicon Bank range. Not much to see until we move out of here, but the moving averages are stacked in the correct order and virtually no change on the week. Tech has been the big powerful one this year, well above 52-week highs, yet it is also the one that has pulled back the most. The 10 is below the 20, price is below both of those and below the 50, though still above the 200. So a little concerning, but it's had a big move. Not worried too much yet. Industrials, this is at new 52-week highs. Moving averages are stacked in the correct order. Pullback has been orderly. Basic materials, still kind of a mixed market. I mean, it's up, it's down, it's up, it's down. Trapped within this big range from last January to October. Hasn't moved out yet. Communications, that was another one of the stronger ones. Broke to 52-week highs back in mid-May. All the moving averages are stacked in the correct order. Price dropped below the 20, but still holding a modest pullback, nothing to worry about yet. Healthcare, now there's a mixed market. It's up, it's down, it's up, it's down. Trapped within this big range, not close to 52-week highs, but not flirting with the lows either, unlike real estate, which is prices below all the moving averages. All those are stacked in the wrong order and closer to 52-week lows. Consumer staples, again, stuck in the middle with you, totally trapped within this range, sideways market, closer to the highs than the lows on the 52-week basis. Utilities, of course, are closer to the 52-week lows. Those are probably the worst performer on the year, whereas tech is the best. Picking up again, now we've got earnings next week. You've got a few Dow stocks, 2 retailers, Home Depot and Walmart, and then Cisco Systems. You've got another semiconductor, construction, discretionary, Deere. You've got another retailer in Target, and you've got a cybersecurity stock in Palo Alto Networks. So finally, I'm going to end on the kind of humorous note, like I talked about last week. You've got 4 bears arguing over who gets to eat the fat hiker. So the bears are back in the mix. I wouldn't say they're getting extraordinarily active yet. Mixed markets. Christmas look to the heat map. Biggies outperformed the smalls, even though they fell back. We reviewed swing traders. We reviewed growth stocks. Risk on remains in effect, and we did a sector review. Light earnings next week, also light data next week. So as my buddy HONU always says, small losers win.